it, and it doesn't create emotional pressure or stress, because that's going to interfere with your ability to follow the rules of the strategy that I'm going to share with you. So in my opinion, using a simulator is better than using real money, because you can learn the same experience, you can have the same experiences, but the cost is so much lower. Yes, you will spend a little bit of money on real-time market data. So if you use a simulator, if you're using a commission-free broker like Webull or Charles Schwab, they give you a simulator for free. It's not a fantastic simulator, doesn't have all the bells and whistles of their live platform. They really would rather use real money because that's where they're going to make money off of your order flow, but it can work and it's good enough. So again, whether you use 1 or 2 shares with real money or you use a simulator, the alpha phase is about gaining a lot of experience to maximize your learning while keeping the cost as low as possible.
Yes.
So for instance, right now, you could pull up that platform, and I'll just pull up my platform just as an example, and I'll just pull up, for the sake of it, Ford. So right here, you've got shares of Ford, and I could go ahead and I could buy 10 shares of this right here on the open market, and this is real money, but by buying it and executing that position and seeing that show up there in my order window, I'm beginning the process of learning how this software works. And the software, like anything else, has a little bit of a learning curve. So if you start by just getting your hands in there and taking some trades, all of a sudden you're gonna realize, well, wait a second, what is this Edge X mean? What is that? What is this? What is this? What is this? And of course, I'm gonna walk you through that, a lot of this in today's class, but as you get your hands into the software and start practicing, you're gonna start to become, you're gonna become immersed in learning the language of the financial markets. Because I think learning to trade should be thought about in a similar way as learning a language. When you learn a language, you want to surround yourself with people who are speaking the language, right? It's always going to be easier. And so the sooner you jump in and you start actually trading, you're putting yourself you're immersing yourself in the environment where you're forced to learn. So it's like jumping right in the pool and you've got to figure out how to swim. Now, of course, we're using the simulator, so the downside risk isn't drowning or losing real money. There's really no downside risk of using a simulator. So most days, there are enough stocks experiencing some degree of volatility throughout the entire day to give you the opportunity to put in time studying level 2. Studying your ability to read the tape, studying your ability to read candlestick charts, and even studying your ability to choose and find these stocks that are volatile, all of which you're going to learn a lot more about in today's episode. So step 1 is start practicing. Just start getting your feet wet and getting in there, because a lot of the things that you might have of theory of how trading works, how it works to buy and sell, a lot of those questions are going to be answered just as you begin pressing those buy and sell buttons. Step 2, I want to talk about risk management. We know that trading is risky. I'm not going to sugarcoat it. It is. Here's the reality. Most beginner traders come into the market and they lose money. And what happens is their very first trade, which was the case for me when I got started, is a loss. And so what happens after you have that loss is you immediately feel frustrated and angry and disappointed. And you don't want to feel that way anymore. And so the best way to no longer feel angry, frustrated, and disappointed, you take that first trade, you lose money, now you feel sad. So how do you make yourself not feel sad anymore? The fastest way to not feel sad here would be to make back money, right? To go green. So that's going to encourage you, this emotion, to take more trades. But since you don't yet have a strategy, what's actually going to result is you're going to lose even more money, and you're going to get even more angry, and then you're going to take even more trades, and you see where this is going. And this has happened to countless traders. It is a negative feedback loop. It is created with a poor track record, poor self-confidence, increased losses. And
listen, bro, I don't know where most people get this. I understand how it feels to lose money and everything, but bro, like when you are hopping into something that you are bound to lose money in, why are you so surprised that you lost anything at all? Like, why don't you take that as a piece of information, right? Why don't you take that as a piece of feedback and be like, okay, hey, this didn't work. Let me see exactly what I messed up in, exactly how it messed up, exactly what was my mistake. Maybe I'll take a picture of it and ask Grok myself, and he'll tell me. And that's it. Learn from your mistake. You don't
a degree of emotional
wallow
hijack,
in your freaking
hijacked by your emotions of frustration, disappointment, and desperation. And I've been there. When I got started trading, I wasn't in the financial place that I am certainly today. I was in a place where I really needed the money that I hadn't thought that I could make in the market. And when I was coming up short, I was getting angry, I was getting frustrated, and that all led to more erratic trading, which resulted in even more losses. So how do we break this cycle? Well, I think number 1, developing an awareness of the tendency to fall in this cycle is probably the first step. The way to break the cycle is interesting. It's by focusing on high-quality stocks. Now, trading high-quality stocks, to me, is one of the best forms of risk management. You might not think of that initially as a form of risk management. Shouldn't risk management just be choosing to risk less money? Well, sure, that's one way to look at it. If you risk less money, you'll lose less, but it doesn't mean you're going to necessarily make money when it works. So the first element of risk management is trading A-quality stocks, because let's think about this for a second. If you have a system, if you've got that niche, right, of I know that when I trade these types of stocks, I'm right more often than I'm wrong, 65%, even if it's just 51%, you've got a slight edge. Then you focus on just trading those stocks. But by just trading those stocks, because you've got this track record, or because you know that this is a strategy that's proven profitable by others, you're going to see a higher profit loss ratio. Then you're going to see improved consistency. And this creates the positive feedback loop. So now the positive feedback loop, every trade you take is just encouraging you to trade with greater size, to be more aggressive. So you begin the process of scaling up. But you can't do that if you don't have a track record. So here's the blessing and the curse of the market. You could spend years struggling to make $10 a day. That's the curse. That's terrible. That's what it was like for me when I first got started. I was showing up every single day. I had modest goals. I wasn't trying to make a lot of money. I was living in Vermont. Cost of living was low. I was in my 20s. I was single. Life was pretty mellow in those days. And so for me, if I could make $100 a day, that was phenomenal. So I wasn't setting the bar high at all, right? I wasn't trying to drive a Lamborghini or fly in a private jet. I was just trying to make $100 a day, $200 a day.
My nigga, $25 a day is my goal. $25 a day is my goal. If I cannot make $25 a day trading, I'm cooked.
Was it? And I couldn't do it. I'm not being greedy. What's the challenge here? What's the issue? Well, the issue is you're not going to make $10 or $100 a day consistently until you've got a consistent strategy. Yes, you may make it a couple days out of the week, and then you lose $50 on Thursday and Friday, and you finish the week in the red. But here's the blessing of the market. Once you've found that niche, once you've discovered that little strategy that works, even if it's boring, it's not exciting, but it's consistent, and you're doing $10 a day, the only difference between 10 and 20 is increasing your position size, and then 20 to 40, 40 to 60, 60 to 80. So early on in my career, I was trading a much smaller size naturally than I am today. That's what's allowed me to scale up my trading to the level where I've had multi-million-dollar years in trading profits. I never would have imagined it, but that's the blessing of the market. So your job right now is to focus on getting yourself on this positive feedback loop, and it begins by focusing on high accuracy. Now, there is the reality when it comes to trading that there's a relationship between winners and losers. So you've got your profit to loss ratio. This is something that we talk about quite a lot. So the profit to loss ratio, if you on average risk $2 to make only $1, you know what your break-even percentage would be? Your break-even percentage is that you have to be right 66% of the time just to break even. If you lose $2 for every dollar you make. On the other hand, if you make $2 when you're only risking $1, you only need to be right 33% of the time. Now, naturally, 1 to 1 is 50%, right? So if you risk $1 to make $1, you only got to be right 50% of the time. But I'm going to encourage you to focus on this area here, where you risk $1 to make $2, because you only need to be right 33% of the time to break even. In other words, you're setting the bar really low. Even if you're right 40% of the time or 50% of the time, you're not just breaking even, you're making money. So now what you've done is you've put statistics and odds in your favor by understanding that whenever I'm trading, I need to look for an opportunity that gives me the potential to double whatever I'm risking. So if I'm going to risk $1, it's because I have the potential to make $2. Now, in order to really understand risk and reward, you've got to be able to understand the language of candlestick charts, because that's where we actually look at support and resistance and identify that, well, how far is my current entry from support? Because that's my risk. And then how far away is my next profit target? Because that's my reward potential. Now, ultimately, we never know how much a stock will go up, but we can concretely control how much we're willing to risk. And so always ask yourself that question before you take a trade. Does this give me the opportunity to double whatever I'm risking? Now, sometimes people will inadvertently think of risk as, oh, I put $5,000 into this position. I'm risking $5,000. That means I need to make $10,000. Well, hold on a second. If you put $5,000 into Ford Motor Company, you're not risking $5,000 unless you're planning on holding until it goes to zero. No one's going to do that, right? So what you're actually risking, since you own an asset of value, is the difference between your entry point and where you would sell it for a loss. And so you might say, I own $5,000 worth, but if it goes down 10%, I'm going to take a loss. So I take a $500 loss, and that's the most I'd be willing to lose, and then I'll get back my $4,500. So in that example, if you made $1,000 on that trade, you bought $5,000 worth and you sold it when it was worth $6,000. Some people would say, oh, you made $1,000, but you risked $5,000. And I would say, no. You're risking 10%. You're risking $500, and you made $1,000. That is a 2 to 1 profit to loss ratio. And I would take that trade that are making the biggest gains. And on this particular day, it was GLTO. Now, when I look at this scanner, this is a piece of software, and it's an app you can use on your phone, or you can also use it on a computer. I use it on a computer, but I check it on my phone as well, actually. And what it's doing is it's sorting the leading gainers in the entire market from the percentage gain. So if this is the leading percentage gainer, then this is the ticker, which is the abbreviation for the company. This symbol right here tells us it's a flame if the stock has news. So if it's got news within the last 2 hours, the flame is red. If it's within the last 12 hours, it's orange. And if it's further back than that, then it's yellow. It's got to be within 24 hours. This tells us the price of the stock. This tells us the amount of volume that's traded hands. And this tells us the float, which is the number of shares that are available to trade. That number is determined when a company does an initial public offering. They choose to sell a fixed number of shares onto the open market. That money is then raised. The company uses it to grow the company, hopefully become more profitable. And then obviously all the shareholders will benefit from that, either from the price appreciating in value or potentially from a dividend. Now, usually these lower price stocks don't pay a dividend. But one of the things that I want to share with you is I want to pull out some data points from all of my metrics, all of my historical data. So all of this data right here, what I want to do is pull out a couple of key points that essentially tell you my strategy, and then I'm going to articulate exactly what it means. So this data point here says that I make the majority of my profit, you can see right here, on stocks that have 500% higher volume on the day I trade it than the instrument's average volume over the last 50 days. So in layman's terms, this stock has 5 times above average volume today than it's normal, than what's average. So just take that right there. It's like something really significant is happening to this stock today to allow it to have that much volume. That we know. What is going on? You're going to find out in a moment. But something significant is going on. And so clearly, if I'm looking to find a stock to day trade, I should at a minimum look for a stock that currently has 5 times above average volume in today's trading session. That would be logical. That's what my data tells me. And I should also look for a stock that has high total volume today. Now, just because something has higher volume than average doesn't mean it actually has high total volume. If the average volume is 1,000 shares and today it has 100,000 shares, it's above average, but the total is still very low. I don't do very well trading stocks with low volume, as you can see right here. I make more money as the volume goes higher. And that's because when a stock has more volume, I can buy and sell more shares. So if a stock only has 10,000 shares of volume, buying and selling 10,000 shares would naturally be impossible. If a stock has 10 million shares of volume, buying and selling 10,000 shares is easy. In fact, you could probably buy and sell 100,000 shares. And if you're taking 100,000 share positions, then all of a sudden, every penny you make per share is $1,000. You make 10 cents per share, it's $10,000. So this is where all of a sudden you start to see my average daily gain can increase very quickly. And it's because of the fact that I'm trading with bigger share size. I wouldn't be able to trade bigger share size if we didn't have higher volume. So if you look at my profits here, this is showing the last 12 months, and my average daily gain is $28,000. $28,000 is a lot of money. But you might think, wow, I must be buying, a position and the stock is just going up a crazy amount. Well, what we're going to look at here, I'm going to do a little comparison of my winners, and we'll just do year to date compared to my losers year to date. And I want you to take a guess right now at what you think my average winners are in cents per share. My average winners in cents per share is only 18 cents. Only 18 cents per share. But naturally, if I took a 10,000 share position, that's $1,800. If I took a 100,000 share position, that's $18,000. And so I don't take 100,000 shares on every trade I take. But the point remains that when I take a bigger size, I can make more money. But averaging $27,000, $28,000 per day is not because I take just one trade a day. I'm at a point in my career where on a good day, I might take 10, 15, 20 trades. We might have that many really good opportunities each day. And through this year, as we can see, my average accuracy has been right around 71%. That's pretty solid. My average winner is about $3,500. My average loser is $2,000. It's not to say, this is perfect. I would prefer to have a perfect 2-to-1 profit loss ratio, which means my average winners here should be 4,000, or my average loser should be a little bit smaller. But this is the reality of where, the dust has settled over the last 12 months. But I can feel good about this because my accuracy is high, and naturally the total profit here of $6.3 million.
Damn, 71% accuracy.
So
That's pretty
it's
good.
important for me to focus not only on stocks that have 5 times relative volume today, but also on stocks that have higher total volume today. I also need to focus on stocks that are gapping up. Gapping up means the stock is moving higher than the previous day. When it's higher than the previous day, we call that a gap. So in the pre-market session, it's already trading at a higher price than it closed the previous day, which is what's going to create the gap in the overnight chart. So candlestick charts, as you're going to learn as we get into that in today's class, the daily chart, those candlesticks are based on the trading action that occurs between 9:30 a.m. and 4 p.m. However, as you may already know, many markets are actually trading 24 hours a day. But after 4 p.m. and before 9:30 a.m., the volume tends to be a little bit lighter. And so when we look at a daily candlestick chart, it's only factoring the price action that occurred between 9:30 and 4 p.m. Now, I often start trading at 7 a.m., which is when we begin to typically see some good volume. And some traders will trade till as late as 6 or 7 p.m. 8 p.m. is not uncommon. But generally speaking, although for me, the majority of my trading is in the morning, candlestick charts are based on the 9:30 a.m. to 4 p.m. window. And so that means if you have a stock that closed the previous day at $4 a share, and now at 7 a.m. they put out breaking news and goes up to 6, 7, 8, then overnight it's gone from 4 to 8. And so that creates the gap. And so I make more money trading stocks, as you can see, that have been gapping up at least 10%. So what I'm doing here is I'm going to break these down for you, and then we're going to put them into a list so you don't have to be writing them all down. They're also in the PDF. So if you guys have already downloaded the PDF resources that accompany today's class, then you'll have copies of this and you can print it out and use it as you'd like. But I'm also going to list it for you in just a moment. So focusing on stocks gapping up is very important. So why would a stock gap up with 5 times above average volume and high total volume today? And the answer is because the stock and the company have put out breaking news. So I am a volatility trader. That is my niche. I focus on trading volatility, and the volatility specifically that's created by breaking news. Now, I also focus on trading stocks between $2 and $20 because they can offer larger percentage returns, which are great for account growth. I focus on essentially a strategy that in its inception for me was based on how to grow a small account because that's what I had when I got started. Even though I've gotten to the point today where I don't need to have a small account, I still keep my account relatively small on the smaller side because I don't need all the extra buying power. There's a little bit of a limit of just total how many shares you can buy on some of these small cap stocks. You can't buy 5 million shares of them. I mean, even if it has 50 million shares of volume, that would be a lot to buy and a lot to sell. And so, in a practical sense, I've kind of reached the plateau of how much I can scale up my strategy within the small cap market without venturing into other markets. Now, I do that in a separate larger account, but that's not the focus of today's class. So for today's class, we're focusing on the small account growth strategy. And this is the tried and true strategy that I've been using full time every time I've done a small account challenge. So what we're looking at here is a very specific subset of stocks. And these are stocks that typically have a float of under 10 million shares. Well, let's look at this. This is the top gainer scan on this particular day. And you can see all of these stocks, 400%, 200%, 160%, 58%, 50%. All of these stocks clearly have huge gains. And look at the float. The float on all of these stocks is less than 20 million shares. And these ones here, these top 4, the float is less than 10 million shares. They all have higher volume, right? These are all priced under $20. These are the top 4 stocks that I would definitely be paying close attention to. But here's the thing. I would have known that this stock had the potential to make this big move even when it was up only 40 or 50% because it shared the characteristics that I found really are the common denominators among the biggest movers that we see in the market. So in order for stocks to make a big move, they need to have ultimately an imbalance between supply and demand. Supply is the float, the number of shares available to trade, and demand is created by a breaking news headline. However, demand is always higher on stocks that are lower priced, and I really love the price of between 5 and 10. Like, this is a real sweet spot for me where I can do extremely well. Stocks are in a hot sector, and the sectors, that are hot is sort of cyclical. They can change from time to time, but crypto, biotech, AI, if the time is between 7 a.m. and 10 a.m., and then you get that high relative volume because so many traders are excited to participate in trading this stock where they see that it's got news, it's moving higher, and it's giving familiar chart patterns that help us understand risk and reward. And so if I jump onto a chart here, this is the example of MLGO, where even early in the morning here when it was up, 75, 100%, I knew it had the potential, and this thing just kept cranking higher all day long. It ended up going up 432% on over 300 million shares of volume. This was very liquid. There was a lot of opportunity to trade this. It was a low float stock with very high demand, and that's what resulted in this big rate of change. So if we're going to look at it added on a list, these are my 5 pillars of stock selection. The stock has to be already up at least 10% on the day. It needs 5 times relative volume. It needs to have news to be an A quality setup. There are exceptions to this where we'll have sector-wide catalysts that I will trade, but those are always going to be a little riskier. So in terms of A quality, we need to have news. Number 4, the stock should be between 2 and 20, but between 5 and 10 is even better, and the float should be less than 10 million shares, but lower is also better. These 5 pillars are what I look for every single day when I'm trading, and so I actually have a scanner, and I'm using that scan every single day to show me the stocks are worth considering. And so this is the software that I'm using, and this right here is my 5 pillars alert scanner, and this is showing stocks that currently meet all 5 pillars of stock selection, and in this current moment right now are worth trading. So sometimes a stock will meet all 5 pillars, but then it'll sell off. Like this one met all 5 pillars, and then it reversed and it came back down. So at that point, it was no longer worth considering, so it dropped off this scanner. So the way that I find stocks each day, essentially, is I've told these scanners exactly what to look for, and they search the market, and they come back and trigger the alert, and it includes an audio notification. So now I'm getting the ding or the bell, and I'm pulling up my charts, and I'm saying, okay, here we go. It's game time. We've got a stock moving higher, and I get it. It meets my 5 pillars of stock selection, and now all I have to do is pull up the candlestick chart pattern and start looking for that entry. Now, for those of you guys that haven't used stock scanners before, I will also put a link in the description for a 2-week trial where you guys can use the software. It is $20. You got to use, when you use the software, you got to pay for real-time market data, but you want real-time market data. And this software will give you the charts, it'll give you the scanners, it'll give you the news feed, and so you'll really be able to have pretty much everything you need except for your broker. You'll have to execute, or a simulator to execute your trades there. So now if we jump back into the slide deck here, we're going to go ahead and jump into step 4, which is understanding candlesticks. So first step is just practicing a ton in the simulator. Second step is understanding risk management. And then obviously what I said is the first step of risk management is stock selection. Now, if you found a stock that meets all 5 pillars of stock selection, you're not going to know where to buy or sell because you don't yet understand how to read candlestick charts. And so let's go ahead and jump into it here. Step 4, candlestick chart patterns. So this is a reference, and this is included in the PDFs that you guys download. So you can print this out if you'd like and put it over on your desk or wherever you'd like. So when we're looking at candlestick charts are providing us the historical context. What it's doing is it's telling us everything that the stock has done in the past, how much it's gone up, how much it's gone down, so we can see how it's traded. And we can see the amount of volume that each of those candles were trading on. So when we look at the history of a stock, we pull up the chart and we typically start by looking at the daily chart. So on a daily chart, every individual candle represents 1 day of price action. Now, typically when a candle is going up, it's green, and if it was going down here, it would be red, but just for the sake of doing it quickly, I just did it all in green. So if this was a daily chart, every single one of these candles would encompass all of the price action that occurred between what hours? The hours of 9:30 a.m. and 4 p.m., right? Now, how are these candlesticks created? A candlestick is created with 4 pieces of information. So if we jump on the slide deck here, the 4 pieces of information we're looking at, whether the candle is red or green, are the following. I'm going to draw it. We've got the open, which was the starting price, and then we've got the close. Now, those are 2 pieces of information. Those are obviously important. So if the price opens low and closes high, those are 2 data points. There's 2 others that are valuable. The high of the session and the low of the session. So let's say it opens here and the price drops down to this low point here, but then it surges all the way back up to a high point here, but then ended up closing about here. So the way we would draw the candle with these 4 data points is the open and the close are connected like this into what's called a candlestick body. And the high and the low are connected just by lines, which are called candle wicks, or we sometimes call them a shadow. So a lower shadow and an upper shadow. So in this case, what is this candle shape communicating to us? This tells us exactly what happened. The price opened, obviously it dipped down, it obviously went higher, and then it closed. Now, if this candle was green, then we know it opened at the bottom and closed at the top. If the candle was red, it opened at the top and closed at the bottom, indicating the price went down. So now what I want to do is I want to introduce to you the concept of what different candlestick shapes can communicate about market sentiment. So we're going to start with a long body candlestick. A long body candlestick is a candle that's a very tall shape. And so if I draw this on a chart, right here we've got candles and they're getting progressively bigger. So what does a long body candle like that communicate? This is a very bullish candle. Bullish means strong, strong like bull, so very strong momentum. This is what we like. So a long body candlestick is very, very positive. Those are plus marks. A smaller body candle like this, well, it's a little indifferent. Now, what if we had a stock, for instance, that had large body candles and then they started getting smaller? Well, if they got small enough, we might almost think that the price is beginning to reverse, potentially. And so the size of the candlestick helps us understand how strong the momentum is. Sometimes a stock like breaking news like this, news comes out and the stock squeezes up, and then it starts doing one of these. And the problem when it does this is it feels like, quite visually, that momentum is just tapering. It's getting weaker. We don't really want to see that. We'd like to see the opposite, where the news starts and then the candles start getting bigger and bigger and bigger and bigger, and it's ramping up. We'd rather see that ramping up action. But if we saw ramping up action, then we saw it begin to slow back down, then that would also tell us, okay. And that's exactly what happens always with price action. We have periods of exuberance and really rapid rate of change, fast movement, and we love trading in this area, and then it kind of cools off. So your job is to learn how to pick up the signals when you're looking at the candlestick chart to recognize, is the price about to pull away and start moving faster? Is the price about to slow down and potentially reverse? So when we're trading, one of the things we want to pay really close attention to are the moments when the direction is changing. So trending up and then trending down, and then back up and then back down, and then back up and then back down, and then back up and then back down. So the changes. If you were able to get in every time it changes from down to up and then get out right here, you would make a ton of money, right? Now, obviously, you would only make money if the underlying instrument that you were trading had range, was going up 50% or something like that, which means it needs to have some type of breaking news catalyst. But if it had the breaking news catalyst and it was moving, then your job is to try to find these apex points, these pivots, as quickly as you can. And the sooner you get in, the better off you'll be. But of course, you don't want to get a false breakout and then, oops, catch another drop back down. So obviously, this is simplifying it. To do it consistently requires that sort of nuanced ability to recognize the difference between a pivot here that is bullish and is going to reverse higher and one that is bearish, weak, and is going to continue lower. So long body candles are our favorite, and anytime I see them, it's a good thing. It means the stock is moving.
Yeah.
Even if I'm not in the position already, it's still okay because at least the thing is moving. So short body candles, I don't like them as much. I mean, they just don't communicate as much strength.
Yeah.
But what's even worse than a short body candle is a doji candle.
Yeah.
A doji candle
Yeah.
It's a very interesting shape, as you can see here. It's when the open and the close are at the same price. So isn't that funny? What we have happen is we open and close at the exact same price. Then we have a high and we have a low, which is connected by the line. So what ends up forming is this sort of funny shape. So there's a couple things here. Number one, if the price is already going sideways and we're in a range-bound market where it's only up and down, 2%, then dojis are not really that significant. Because what is a doji? A doji is a candle of indecision. Well, the price is going sideways. It's already indecisive. So we don't really care about dojis in that context. What about this? We have these long body candles. It's looking really good. And then all of a sudden, we have that candle. Now, that means something. Really bullish sentiment and then a candle of indecision. That means that for some reason, the buyers are not as confident as they were. This next candle is going to open at approximately the same price as the close. And we're going to worry about a reversal back down. And if we get a red candle, then it's very likely another red candle will follow as people begin to exit their positions. But what if that happens? Ooh, well, now we've got a candle of indecision at the bottom. And so what you're going to learn is that these candles of indecision often mark the pivots right here. So look for these candles of indecision before buying and selling. Before buying, when you're looking for the reversal back up, and to consider selling when you're seeing it at the top of a move. So a doji candle can come in a couple different varieties. We've got the doji that's called a gravestone doji. A gravestone doji has the opening close, and then it has a larger upper tail, like that, upper candle wick. The dragonfly doji is a little top like that, and then the lower wick. And then the long-legged doji looks like this, where it's got the top and the bottom.
Introducing Iron Beam, a bright choice for futures trading. Iron Beam is an industry-leading broker catering to traders worldwide. With 24-hour live support and the free Iron Beam platform, you can trade the most popular and liquid future contracts anywhere and from any device. With day trade margins as low as $50 and no account minimums, futures trading is more accessible than ever. Register now and let us help you shine a light on futures trading.
Spinning tops are kind of like dojis. They have a little body, but they also have that upper candle wick and lower candle wick, and so they communicate pretty much an equal amount of indecision when we see them in the context of a trend. A hammer candlestick in the context of a downtrend is bullish. Why is this bullish? Well, the stock dropped to this low, but then was able to rally back up and close, in this case, green. It's called a hammer because it's said to be hammering out the base. Now, candlesticks are Japanese in origin, and so the names of the candles often are designed to communicate the sentiment that we're supposed to interpret from the shape. So this is a shooting star. Right here, we've got a shooting star, so that's the body with that longer candle wick, and shooting stars come back down. And so shooting star is indicative of a potential reversal. This is a tweezer top. So these tweezers here, it hurts if you get pinched by a tweezer, I guess. I don't know. But you've got this rally up here, and then the tweezer top is bearish. That's not good because you've got not just one top and tail. Essentially, it's almost like two back-to-back shooting stars, and that's not a good thing. Now, a tweezer bottom could be indicative, however, of a reversal back up. So in that case, inverted, it's a positive thing. So when I'm looking at these candlestick shapes, the individual candlestick shape informs market sentiment. Now, when we have multiple candlestick shapes together, they create familiar candlestick chart patterns that I utilize to time my entries and my exits. So I'm now going to share with you step 5, the one simple pattern. This is the niche. The whole idea here of this class is to just teach you one simple pattern, one simple strategy that you can begin implementing today. Even if you only take a couple trades a week, it's not about taking a ton of trades. It's about quality over quantity. This can be your life raft. This can be the setup. You trade in a simulator and you log your trades and you prove that you can actually do it profitably. So the simple pattern that I want to teach you, this is when we have a stock that first starts surging up. I'll hide my video here. We find the stock on my scanner. So the scanner's right here. I'm getting the alert. Boom. UPXI hitting the scanner. It's got the news. It's got news. It's got a very low flow. Right now it's got lower volume total, but it's popping up. So we pull it up and we see the stock's got news. We then look at the candlestick chart, and I'm not looking at the daily chart here. In this case, what I'm looking at actually is the 1 minute time frame. So that means each candlestick represents just 60 seconds of time. So this is a very fast moving chart. Now, we still have the daily chart. We look at the daily chart, and I'll tell you what we look at there. But then we set the daily chart aside and focus on the intraday chart pattern because as day traders, we're getting in and out so quickly, the daily chart no longer is, once we've set context and we understand what it looks like, then we focus on intraday time frame. So now we're on the 1 minute chart. I let the stock squeeze up. I can't just buy it right here. There are some advanced techniques that you could use, but this would generally be very risky, especially for a beginner. It's going to have lower probability, higher risk. So I let it squeeze up and I let it pull back. This is the moment of truth. If this stock is really strong, if the news is really good, it will hold here. If the news is bad, it's just going to keep going lower. So what do I look for? In this moment, right here, I'm looking for a change in trend. Now, a change in trend could be indicated initially by what? A potential doji candle. So a potential doji candle could give me the indicator that the price is beginning to bottom out, that buyers are buying it up off the low, which is creating that bottoming tail. However, a very obvious sign of the trend shifting would be, number one, a candle that is green in color because it's closing higher than it opened. And number two, the first candle to actually make a new high versus the previous. Because these candles are going down. They're going down. They're going down. So the first candle that starts going back up is making the pivot. So right in this moment, right here, the second this stock breaks the high of this red candle, I'm a buyer. Where's my max loss? It's the low of this candle, the low right here of the pullback. So let's just say that's 10 cents of risk. I'm risking 10 cents per share, so multiply by the number of shares I bought. And my profit target, my first goal, is a retest of the high of day. So I want to make sure I can make at least 20 cents between my entry point and the high of day. If I can do that, I have a 2-to-1 profit to loss ratio, and I'm going to take the trade. And so what I want to see is that rally, and if it pushes even higher, that's great. Just because it hit my profit target doesn't mean I need to sell the whole position. In fact, I don't want to do that. I want to cap my losers, but I don't want to cap my winners. So I want to hold my winner until I get a valid exit indicator. What does a valid exit indicator look like? The first candle that closes red. The first candle that closes red. Now, obviously, if the next candle opens and begins going red, I can be watching the time. So one of the things that's nice about trading is while you're trading, we know that these candles, if nothing, are consistent about the time that they open and close. So they open and close naturally at the top of each minute. So if I'm watching and I see that there's only 20 seconds left of the current candle, then I know that the shape that it's currently appearing to be will likely become the shape and become a permanent record of history. Now, when it's the first 5 or 6 seconds of a candle, there's still the potential that it could go from red to green. It could change. So I like to give it a chance and I like to hold. Obviously, there's nothing wrong with taking profit when you have it. And if you've got hit your target and you want to take half of your profit off the table, that's fine. There's nothing wrong with doing that. But it's also generally a good idea not to cap your winners and to wait for a valid exit indicator before selling the entire position. So now let me give you a little pop quiz. So here we have this actual chart. This is the real stock right here. It pops up. And we're going to assume right now this stock meets our 5 pillars of stock selection and has breaking news. So we like it from all of those perspectives. So now right now, what are you looking for? You're going to be looking for that first candle to make a new high, right? So right there, it happens. The first candle makes a new high right there. So that's your entry point, right? Now your max loss in this case is the low of the current candle because it made a low and then reversed back up. So that's your entry, that's your max loss. Your profit target is right here up at the high. And there you get that squeeze through the high. Now what you're seeing down here are the volume bars, which represent the number of shares that traded hands in each one of these candles. So we saw increasing volume on the green candles, and then the volume decreased a little bit on this red candle, and then the volume came right back in on the next green candles as it surged higher. And that's the type of pattern that we like to see. So a candlestick chart is not just about looking at the individual shapes of the candles and the patterns they're forming, it's also noticing the volume profile, the profile and distribution of the buying versus the selling, and observing some of our technical indicators like this one right here, which is called the MACD. When the MACD is positive, the blue line is above the orange line, this is typically a more bullish place to be taking a trade. When they're inverted and negative, it's typically more bearish. Now, for those of you guys who are saying, this is a lot, there's a lot of details to follow here. One of the things that I will share with you is that every single day while I'm trading, I run a live audio video broadcast right into my office. So you can watch over my shoulder. You can see my screen share. You can see my position window. You can see my orders. You can see everything. And you can hear me talking because I provide my market commentary. So I share with you what I'm observing. Now, I've been doing this for a long time. And what I've learned is that this is a real value for beginner traders because as you're immersing yourself in the market, you want to surround yourself with people that are speaking the language. And I speak the language of the market and I'm fluent in it. And so by listening to me articulate what I'm seeing in real time, it makes it easier.
Now this man is providing psychology, bro. Am I subscribed to this man? Bro, hey, bro. Ross Cameron, dude. God bless you, bro. That's all I'm gonna say. Where's my video, dude?
Subtle cues, because there are, on these charts, there are clear buy and sell signals. I see them. Your eye may not yet have been trained to see them. So here we have another stock that's rallying up. This is a fantastic move. So of course the stock is hitting our scanners, it's moving quickly. Then it pulls back. We've got this bottoming tail candle. Then boom, volume comes in. First candle making a new high, and it rallies back up. So our entry's right there. Now, this is a stock that would have been on the scanner. So as it hit the scanners, I would have been saying, okay, guys, I'm watching this for the first pullback. I want to let it pull back because I can't buy it in the middle of this move. It's too risky. So I'm going to let it pull back. I'm going to let it base out. And I'm going to give it a chance to fail. If it comes all the way back down, there'll be no trades on it.
Yeah. Ooh, I fuck with it, buddy. Yo, I fuck with this day. Bro, hey, I fuck with this nigga, bro. This is the kind of shit I need to hear, bro. Hey, nigga, bro, this nigga was born before me, bro, so that he can show me this shit.
I'm going to give it a chance to fail. If it comes all the way back down,
Bro, I promise you, bro, this is exactly the kind of confidence I have in the trading, bro. That right there, I have so much confidence. Nigga, I could hop in trading right now and try that.
But after it pulls back, I'm looking for the first signs of strength to come back in.
Because that is the most clear, most obvious, most simplest advice, dude, you only need one pattern. He's over here talking about the one singular pattern that I specifically want and looking for. I'm not looking for 100 different strategies, bro. I just need this right here, this common sense.
And on a stock that has fresh breaking news, the first pullback usually gets bought up. It works more often than it doesn't, which is why it's become my little pocket of consistency in the market. The fact is, when a company puts out breaking news and the market's receiving it well and the price is going up, the first pullbacks, people are excited to buy. So here's another example. Now this one's a little different. So here, we see this rally up. We see the pullback. We see this push higher. We probably already, your eye, I bet, caught this higher volume selling. So right here, the
So we'll wait for the pushback again.
There's more sellers than there are buyers, and therefore this is not a safe place to take an entry. Now, in fact, there already was a little entry right here, but I'm just showing you the second pullback. And in this case, it didn't work. The selling was too heavy. Now, what about here? Is this something we should trade? The answer is no. In this case, there might have been opportunities back in this area, but now it's more or less going sideways. I mean,
Yeah.
50 cents a share could be $1 a share, but it's generally going sideways. It's not trending in a strong enough way. So trading in that area wouldn't be predictable. It wouldn't be
Yeah.
Same kind of thing. Yes, the price has moved up, but now it's selling off a little too much. And then this indicator right here is crossed into the negative. Combined with that higher volume red candle, this is not an entry that I would take. It's not a good trade. Higher volume selling, you can see it right there. First thing you see, it's not going to work. Sometimes a stock will pop up on news and just give the game back. Sometimes news can sound good, but ultimately market participants realize that this isn't in fact very good news, and so the initial move gets reversed. So that's fine. If that happens, I don't take a trade. There was no setup on this. So it's not a loser. It's just not a trade at all. Now in this case, we've got high volume buying, a little higher volume selling on that candle, right? So do I take an entry up here? It's a little riskier, but in this case, it works.
Nah, I would have taken that.
In that particular instance, given that higher volume red candle, how good is the news on this? How low is the float on this? Now this has a float of 300,000 shares. That's a very, very small amount of supply. So with good news headline, if this was the most obvious stock in the market today, we might see good follow through. The most obvious stock in the market is something that's important because one of the things you'll recognize is that active traders, they trade what's obvious, what's right in front of them. It's kind of like everyone clicking on page 1 of a Google search. You gravitate towards it. It's just obvious. And it feels like this is the most credible thing today. The stock is up 300%. This is the thing I should be focusing on.
Yeah, exactly. It's obvious.
Here we've got this nice pop up, sideways consolidation. Our MACD is open. The volume profile is not bad. A little heavier selling there.
Yeah. Buy in, nigga. Buy in. I like that.
A little micro pullback, a push higher, another little pullback, and a push higher, another little pullback, and a push higher. So you can continue to trade these beyond the first pullback, but usually, as you see here, as they get a little more extended, they can start to get choppier. Eventually, the MACD will cross negative. That creates more risk in trading to the long side. But then another crossover, another rally back up. Again, being successful is not about taking every single possible trade. It's about trading the highest quality setups, quality over quantity. So if you trade that one simple pattern, the way to execute that trade is by using level 2 market data. The level 2 market data is something you can start practicing if you're in a simulator. You can start practicing trading today. So level 2 data is telling us all of the buyers and all of the sellers that have orders posted on this stock. In the old days, level 2 data was sort of essentially what was created on the floor of the exchange with a market maker. A market maker was a broker that was essentially a buyer and a seller of stock. So they would both post an order to buy and sell. So if you wanted to buy or sell stock, you had to go through the market maker. So you would say, oh, I want to buy, and he'd say, it was always a he in those days. He'd say, yes, I'm willing to buy at, let's say, $10. And then you say, okay, that's great. You sell him your shares. So he buys them at $10. And then someone else comes along and says, hey, I want to buy those shares. And he's like, oh, I'll sell them to you, but I'm going to sell them to you at 11. And so he's making a profit on the difference between what he buys them at and then what he sells them back to people at. So he profits from, he creates a spread, and it's basically, it's kind of scalping, just sort of buying, selling all day long. And he's making the market. So in today's world where the markets are electronic, all the individual traders out there, you, me, everyone else, we put our orders in, and our orders sit basically in a line. People willing to buy, people willing to sell. So at any time, there's people that, in this case, on SLRX, up 212%, 45 million shares of volume, there's people that are selling this right now at 490. And if you wanted to get in instantaneously, you could buy from one of those sellers at 490. You could buy from one of them right away. But if you want to get a better price, well, you'll have to sit on the bid with the other buyers here at 482, or you can put your order at 483. You can move it up a penny if you wanted. There's a spread here at 8 cents, so you could be anywhere in between the spread, but you have to wait for someone to come and sell you shares. If you want the best price, you would do that. But if you want the shares now, you'll buy from a seller. So what I do when I'm trading, when we've got a stock with breaking news that's moving quickly, I don't have time to sit and wait for someone to come sell me shares. I buy from someone who's selling. Because in those moments, what I believe is that this stock is going to go a lot higher, and if I don't get in quickly, I'm going to miss my opportunity. So I pay the higher price and buy from a seller. However, as the stock starts squeezing up, what I like to do is I also like to put my order up on the ask and let someone come and buy my shares. So I try to sell at the best price if I can. Now, if I don't get anyone that buys them, I can always turn around and sell to someone who's posted a bid right here to buy, in this case, at 482. So learning how to execute trades is not just about becoming an expert at reading candlestick charts and those subtle signals that we see on the charts. It's also about learning to read the flow of orders right here on the level 2. So if I pull up my actual live platform right here, we'll do YCBD. But in any case, you put your order here to buy whatever number of shares you want to buy, and your order, there it is. So NASDAQ, it's sitting right there at 122. So my order's sitting there at 122, and if someone wants to sell me shares, I'll buy them. Now, if I wanted to get in instantaneously, what I would do is I would just press Shift 1 here, or if that's my hotkey, I could just go ahead and click the buy button, and boom, I'm in, just like that. Instantaneously, I now own 1,000 shares of the stock at 123. I want to get back out at 123, I put my order on the ask at 123. And now I've got to sit and I've got to wait for someone to come and buy those shares for me. Might take a few minutes, might take longer. I might not have the patience. I might say, I just want to get out, and there's someone here that's willing to buy. So I'm going to go ahead and sell to that buyer. Boom, the shares are gone. And I lost $10 there. Real money, but it doesn't really matter. So in this case, you're interacting with the market. You're buying from sellers, you're selling to buyers. The simplest way to trade for a beginner is to create a simple hotkey on your keyboard. And so if I switch over to the whiteboard here, this is the way I set up my hotkeys. I have one button for buying and one button for selling. Shift 1 right here, Shift 1. I press that and I buy 1,000 shares. Control Z, I press that and I sell my full position on the bid. Whatever my position is, doesn't matter if it's 1,000 or if it's 5,000, it sells the whole position on the bid. And I use those hotkeys because they allow me to get in and out of the market very quickly. Now I have more advanced hotkeys for selling on the ask and taking half off the table and so on and so forth. But as a beginner, one button to buy, one button to sell, easy. Keep it super simple. And I use limit orders. So the limit order that I use is I say I want to get in at 23, but actually my hotkey is going to send the order a little higher than that. So I'm going to send my order at 33, 10 cents above the ask. That way I allow myself a little bit of slippage in a fast moving market. I'll do that for myself on a stock that's moving quickly. And I don't mind doing that. And then when I turn around and sell, I'll sell 22, but then I'll take away 10 cents to give myself a little offset coming back down. Now I don't intend to lose 10 cents on every buy order and every sell order, but if I want to sell 10,000 shares of the stock right now, there's not 10,000 shares that are being bought on the bid. So that means I would sell to whoever's buying at 22, and I'd also have to be willing to sell to whoever's buying at 21, and maybe 20, and maybe 19, and 18 as well. Hopefully not all the way down to 12. But it could happen with bigger positions. Now, when you're trading with small size, 100 shares, you're not going to see slippage, so you don't really need to use those offsets on your orders. You could just buy the ask and sell the bid, but nonetheless, it's a good habit to be in. It's also important to know that if you're trading pre-market, you cannot use market orders. You can only use limit orders. A market order is an order that sends your order to the market and you get filled at any price, but this order here, it's not going to execute because it's after hours. It'll say, nope, sorry, doesn't work. You've got to use limit orders. So I use limit orders in my trading. And you can do that and trade pre-market with all the big brokers out there. It's not a problem. So when it comes to executing the strategy, this again is where we're getting to those sort of subtle details. And so you'll hear me commenting, all right, guys, I'm buying on the ask at 490. Right? My profit target is 525. I'm looking for that squeeze. And on a good trade, it'll go to that level. I'll take my profit off the table by using my hotkey to sell. It goes a little bit higher. I sell a little bit more. It goes a little higher. Sell a little bit more. And then maybe I say, oh, I'm seeing an exit indicator. I see a big seller on level 2. I see, let's say for instance, we saw right here a 1 million share seller at 490. If we saw a seller that big, that tells us that obviously there's someone out there that's selling a lot of shares. So I would be bearish on that position. It's nice to be able to see all the buyers and sellers because you can now draw more conclusion about sentiment. If you see that big seller, you know we're not going to have the green candle go any further up. You already know what the candlestick's going to look like because that seller's in the way. Or if you have a huge buyer, a 1 million share buyer, all of a sudden they create a tremendous level of support, and that's very bullish. So the presence of big buyers and big sellers on the market help educate you as to the sentiment and the strength of the stock. And so when I'm trading every single day, this is one of the things, these are one of the things I'm paying very close attention to. Number 7, it's very important to understand your metrics. And so one of the things that I'm doing whenever I'm trading is I'm tracking all of my trades. Now there's a couple different ways that you can track your trades. So what I do for all of my trades is I use this software right here, and I can go and I can import my trades right here, and you'll see you can import trades from dozens of different brokers. Warrior Trading is on here. We've got our Warrior Trading Simulator. You can import from that. For those of you who are using our simulator, you've got E-Trade, you've got Interactive Brokers. So you import all of your trades, and then once you've imported your trades, you go to reports, and now this is where you can start really getting dialed in at what am I doing that's working. And this, I'll give you an example. So I had a month. This is going to go back. Let's see. It's going to be March of 2024. So I remember this month I traded poorly, and I was really frustrated. I made $20,000, which for me is not a good month. My accuracy was a little lower. My average winners were only $742, while my average losers were $1,100, and I just felt like I wasn't trading well. Now I looked at my details and I saw that I was trading poorly on Mondays and Tuesdays. So you could say, oh, well then just stop trading Mondays and Tuesdays. Okay, maybe. Now it could be that Mondays and Tuesdays are bad. It could also just be that this is a set of data where in this period of time Mondays and Tuesdays were bad. I don't know, but it's a hypothesis that we could think about. I looked a little bit more closely at this next category though, price and volume. And here I noticed that I was losing money on lower price stocks and losing money on higher price stocks. And this is actually a more consistent trend for me over longer periods of time. It's very easy to make bigger mistakes when the price is higher and take losses. And on lower price stocks, they typically don't move enough for me to make a lot of money. And so I get in, I get out, I get in, I get out. I don't have much to show for it, and then I end up with small losses. So the area where I was doing really well, however, was between $2 and $10. So I said, if you want to have a better month in April, what if I focus really on just trading in that price range, right? And there's one other thing that I observed on the days and times. I observed that I'm not doing well early and I was not doing well later. So I said, what if right between 7 a.m. and 10 a.m. I'm a little more aggressive? We stick with trading every day, but I just focus on trading stocks that are well within the price range that I historically have traded best. So I did that, and as I did that, we go to 30 there. In April, I made twice as much money. I ended up doing well on Mondays and Tuesdays, and Fridays were a little slow. But I did well during the window I traded. A little outside the window, lost a little. And in terms of price, I really didn't trade stocks that were more expensive. It just stayed right within this window. And so your historical data has insights. You may not have looked at it yet. If you've been trading for some time, you should definitely import your trading history, because in your trading history, you will find insights. Those insights can help you make conclusions or draw conclusions or have a hypothesis, a thesis about what you could do differently. And for me, it was plain as day. And I suspect for many of you, when you import your metrics, if you haven't already, you're gonna see things in your trading that you wouldn't have expected. Your accuracy, your confidence ratio, the price of stocks you do well on, the price of stocks you lose on, time of day. And so for me, turning the corner, a big part of it was through this long period of trial and error, I realized that, I had all this historical data. And so naturally, there were some trades and all that data that were winners, right? And there were a lot of trades that were losers. But I asked myself, are there things that the winners have in common? So what if I only look at stocks that are between $50 and $100? Is that subset better? No, it's even worse. Well, that's good. It's worse. So what if we cut them out? Okay, that things are looking better in total profit over the last 6 months. What if we take more stuff out? What if we take out anything above 20? It's even better. Great. What if we take away everything below $2? Even better. Okay, now we're getting a sweet spot. What if we narrow this sweet spot down into just between 7 a.m. and 10 a.m.? And so approaching developing your own strategy is kind of like being a scientist. You're sort of, you've got all this data and you're trying to figure out a puzzle, solve a puzzle for profitability. Now, it's not going to work for everyone. You could have a lot of historical data and there's not a profitable strategy in there. That's certainly possible. For me, there was a diamond in the rough. There was a strategy, a subset, a niche that was working. And so then it was just throw away everything else, or at least put it on the back burner and just trade this one setup that works. And that became a turning point. So now let's talk about the beta phase. With the alpha phase, where you're going through, and you could do alpha phase through all the steps I just shared with you. You're trading a lot. You're trading every day. You're trading as much as you can, even less than perfect setups, just to gain a ton of experience, reading level 2, watching the chart patterns. But what you're going to start doing is you're going to start getting to a point where you want to track the trades that might actually, like, you feel like would work with real money. And so there's a transition from simulator to real money. We're going to talk about more in just a moment. The alpha phase is the period of just gaining a ton of experience, and you're not really trying to make money. You don't even really care if you lose money, because this is just about, especially in the simulator, just trading a lot. And then the beta phase is what I call the dry run for going live with real money in phase 1. So in the beta phase, what I want you to start doing is taking one trade a day that is your, like, quote unquote real money trade. Still do it in the simulator, but track it separately from all the others. So basically, you're going to keep taking a lot of trades to gain experience, but you're going to be looking for one really good setup. And you're going to say, this is the setup that I would take with real money. And I want you to do that one trade a day for 10 days. Now, the idea here is that by taking just one trade, we're keeping the guardrails on. Your quality standard is going to be very high. You're not going to take anything that's not phenomenal. Now, track this one trade a day over the course of 10 days. And you're green in total over the 10 trades. Number one, congratulations. That's phenomenal. Number two, it means you're ready to transition to real money. And so when you're tracking all of those trades, this is the sheet that I want you to use. And this is also available in the PDF download. So download this PDF, print out 10 copies of it, and start filling it out every day for the one trade you take. You're going to record the time, the profit or loss in cents per share, whether the stock meets the 5 pillars of stock selection, and then outline the price, the percentage change on the day when you took the first trade, the relative volume, the float, the news, and also note what the catalyst is, the time frame you took the trade on, 10-second chart, 1-minute chart, 5-minute chart. You're probably going to use the 1 minute, which is the most popular, but just throw it out there. The intraday candlestick pattern, you're just going to focus on that one pattern I shared with you, and I call it the pullback pattern. And then you're going to note your hold time. You're going to print a screenshot of the chart right here, or just staple it, and take some notes about your trade. And what I want you to start building is a stack of A quality trades. This is going to become your North Star. This is the strategy. You know, when you follow the rules of it, it produces winners. And so once you've done that, this is when, step 9, you're ready to transition to real money. And so for all of our members at Warrior Trading, I put them on this same plan. Now, alpha phase is gaining lots of experience in the sim, and then the beta phase is when you're taking that one trade a day. And if you've got 10 days like this, or if you're green, you know, you don't have to be green every single day, it's okay. But as long as you're green over those 10 days, you're in good shape. If you're not, just keep trading until you have a 10-day window where you're doing well. And then it's all right, time to graduate and transition to real money. So when you're transitioning to real money, what changes? Absolutely nothing. Your first day, your first 10 days with real money, you're taking the exact same share size you took during the dry run. You're trading with 100 shares, tiny size, because this is not about making money to pay your bills this week. Remember, we're not coming to it with that perspective. This is not about making some money. This is about proof of concept, that you understand the strategy, that you're able to follow the rules, that you have discipline. Because if you can do it with 100 shares, that's what's really exciting. That's, again, the blessing of the market, because now it's time to start to scale up. By trading with 100 shares with real money, you're minimizing your risk of having a big loss. The last thing you want to do is have a great track record in the simulator, fund the real money account, lose money on your first trade, be absolutely livid, furious, and then just abandon everything you know and start trading just to make back the money. Because then you'll end up losing more money and the spiral begins. We don't want that to happen. So that means we have to actually expect that on trade number 1, that first trade you take with real money, you're going to lose. Let's just put it out there. Let's just embrace that this is a fear we have and it's actually going to happen. So how much are you genuinely okay losing on day 1 trade a day? $10? Then trade with 100 shares. You can trade with smaller size if you want, but just take a risk that is appropriate for how much you're totally comfortable losing. And if you say, look, I don't mind losing, you know, $1,000 in my first month of trading with real money, then you might, that's where you're at. Look, everyone's at a different place when it comes to tolerance for loss. But what you will learn is that the reason that we're starting with small size is because you have to build your emotional conditioning to experience loss without getting money. It is really hard for beginners. It takes time. So this is that 9th step. This is where you transition to trading real money, and we want to make that transition as seamless as possible. This is where it gets exciting. If you guys have not already downloaded the PDF resources that accompany this class, I hope you check them out. If you want to trade side by side with me, please check out our 2-week trial here at Warrior Trading. I hope today you have learned a ton about what it takes to start trading. And if you have, I hope you subscribe to the channel. I hope you hit the thumbs up. And I'll remind you as always, trading is risky. My results aren't typical, so please manage your risk and always practice in the simulator before putting your money on the line. And if you want to learn a little bit more, a deep dive into technical analysis, or a deep dive into level 2, I'll put some more episodes here that you guys are welcome to check out. Thank you guys as always for tuning into this class, and I'll see you for the next upload real soon.
So if you want to trade profitably, the best place to start is probably just go to this free community. Yeah, it's free. So I'm in there now. They have a bunch of live events. So all of these guys are 6-figure traders, right? This guy, 6-figure trader. And they go live. They literally just share their strategies, the trades they've taken, the trades they're going to take. They've got a bunch of strategies here which you can just like learn for free. And then people like interact, you know. So for example, this guy here, Alex Morris, he's like sharing his trades and stuff in here. Yeah, and then people are like, man, this is all like, and they're like discussing it. So if you're serious about actually wanting to learn how to trade, like get off YouTube and like come to an actual community like this. It's got like 9,000 people in it. And trade properly, you know.
That nigga said, I go back to the joint.
Usually
Yo!
it works more often than it doesn't, which is why it's become my little pocket of consistency in the market. The fact is, when a company puts out breaking news and the market's receiving it well and the price is going up, the first pullbacks, people are excited to buy it. So here's another example. Now this one's a little different. So here we see this rally up.
Where's my orders,
higher.
bro?
We probably already, your eye, I bet, caught this higher volume selling. So right here, the subtle cue that I'm getting is that there's more sellers than there are buyers. You're selling to buyers. The simplest way to trade for a beginner is to create a simple hotkey on your keyboard. And so if I switch over to the whiteboard here, this is the way I set up my hotkeys. I have one button for buying and one button for selling. Shift 1 right here, Shift 1. I press that and I buy 1,000 shares. Control 10,000 shares that are being bought on the bid. So that means I would sell to whoever's buying at 22, and I'd also have to be willing to sell whoever's buying at 21, and maybe 20, and maybe 19 and 18 as well. Hopefully not all the way down to 12. But it could happen with bigger positions. Now, when you're trading with small size, 100 shares, you're not going to see slippage, so you don't really need to use those offsets on your orders. You could just buy the ask and sell the bid, but nonetheless, it's a good habit to be in. It's also important to know that if you're trading pre-market, you cannot use market orders. You can only use limit orders. A market order is an order that sends your order to market and you get filled at any price, but this order here, it's not going to execute because it's after hours. It'll say, nope, sorry, doesn't work. You've got to use limit orders. So I use limit orders in my trading. And you can do that and trade pre-market with all the big brokers out there. It's not a problem. So when it comes to executing the strategy, this again is where we're getting into those sort of subtle details. And so you'll hear me commenting, all right, guys, I'm buying on the ask at 490. Right? My profit target is 525. I'm looking for that squeeze. And on a good trade, it'll go up to that level. I'll take my profit off the table by using my hotkey to sell. It goes a little bit higher. I sell a little bit more. It goes a little higher. I sell a little bit more. And then maybe I say, oh, I'm seeing an exit indicator. I see a big seller on the level 2. I see, let's say for instance, we saw right here a 1 million share seller at 490. If we saw a seller that big, that tells us that obviously there's someone out there that's selling a lot of shares. So I would be bearish on that position. It's nice to be able to see all the buyers and sellers because you can now draw more conclusion about sentiment. If you see that big seller, you know we're not going to have the green candle go any further up. You already know what the candlestick's going to look like because that seller's in the way. Or if you have a huge buyer, a 1 million share buyer, all of a sudden they create a tremendous level of support, and that's very bullish. So the presence of big buyers and big sellers on the market help educate you as to the sentiment and the strength of a stock. And so when I'm trading every single day, these are one of the things I'm paying very close attention to. Number 7, it's very important to understand your metrics. And so one of the things that I'm doing whenever I'm trading is I'm tracking all of my trades. Now there's a couple different ways that you can track your trades. So what I do for all my trades is I use this software right here, and I can go and I can import my trades right here, and you'll see you can import trades from dozens of different brokers. Warrior Trading is on here. We've got our Warrior Trading Simulator. You can import from that. For those of you who are using our simulator, you've got E-Trade, you've got Interactive Brokers. So you import all of your trades. And then once you've imported your trades, you go to reports. And now this is where you can start really getting dialed in at what am I doing with the order. And this, I'll give you an example. So I had a month, this is going to go back, let's see, it's going to be March of 2024. So I remember this month I traded poorly. And I was really frustrated. I made $20,000, which for me is not a good month. My accuracy was a little lower. My average winners were only $742, while my average losers were $1,100. And I just felt like I wasn't trading well. Now, I looked at my details and I saw that I was trading poorly on Mondays and Tuesdays. So you could say, oh, well then just stop trading Mondays and Tuesdays. Okay, maybe. No, it could be that Mondays and Tuesdays are bad. It could also just be that this is a set of data where in this period of time, Mondays and Tuesdays are bad. I don't know, but it's a hypothesis that we could figure.
What are Indians,
I looked a
bro?
little more closely at this next category, though, price and volume. And here I noticed that I was losing money on lower price stocks and losing money on higher price stocks. And this is actually a more consistent trend for me over longer periods of time. It's very easy to make bigger mistakes when the price is higher and take losses. And on lower price stocks, they typically don't move enough for me to make a lot of money. And so I get in, I get out, I don't have much to show for it, and then I end up with small losses. So the area where I was doing really well, however, was between $2 and $10. So I said, if you want to have a better month in April, what if I focus really on just trading in that price range, right? And there's one other thing that I observed on the days and times. I observed that I'm not doing well early and I was not doing well later. So I said, what if right between 7 a.m. and 10 a.m. I'm a little more aggressive? We stick with trading every day, but I just focus on trading stocks that are well within the price range that I historically have traded the best. So I did that. And as I did that, we'll go to 30 there. In April, I made twice as much money. I ended up doing well on Mondays and Tuesdays.
All right, so now that we got this information right here, man, we're going to actually try to go about this with the AI now, because AI is going to be the only person that's going to actually tell me like a fucking human being, not like a video. So let's go ahead and ask this nigga. Hey, nigga, I want to get into trading, and I literally don't know where to start. Like, I deadass don't know where to start. I just watched this video, bro, and it's explaining, like, bro, obviously hop into simulator trading first before you hop into trading, and then you can obviously start trading some real profits. I obviously, before I even start making real profit, I want to make, like, at least $25 a day trading. I think that's pretty humble. I think I make $25 a day on a bike, and I'm pretty humble and accept that as long as I get to stay at the house and make videos, edit, make content, because content is my snitch. That's my love. Okay, I want that's for the love of the world. All right. I also have for the love of the riches of the hunt, man. Of course, you know, passive and active investment income. But other than that, I also would like to have passive and active income, which is Uber Eats and the other passive income for me. What I'm doing here, making content, passive. So I want to do active income with trading, investing, and then with basically day trading. And then passive income, which investing, which is dividend stocks. So basically buying over and over again and just waiting for the stock to go up, obviously. And then obviously I have a high yield savings account so that I could pay taxes without having to worry about actually holding the money and it not doing nothing at all. At least it's making money while it's sitting there. And I can actually pull the money out by the end with all the Uber money that I made, and maybe even stock money or whatever the frick I've been doing all year, bro. I've been selling vacuums, car seats, a bunch of random miscellaneous stuff, and I've just been making money several different ways this year, and I have to pay taxes, of course, so, you know, I would like to learn how to actually make bigger profits so that I can actually, you know, get forward with this.
Start with the basics. Don't touch real money yet. You're smart to want a simulator first. That's the right move. Here's your actual starting path. Keep it simple. 1. Learn the absolute basics. What stocks are, how prices move, what a broker is. Spend 1 week watching free beginner videos on YouTube. Channels like The Plain Bagel or Investing with Rose are good and hike you up. 2. Open a paper trading account.
All right, guys, we're gonna search up investing with Rose, and we're also gonna search up bagel or something like that. What was it?
The channel I mentioned is called The Plain Bagel.
Plain bagel. So we're gonna search up the plain bagel, and then we're gonna search up. Hey. Okay, so the plain bagel and investing with Rose. Oh, what's it? Did she crash? All right. Now that we got these two channels, we got a little bit of AI, information that'll help us, apparently, so-called. These people are Canada's Tax Explained. Trading versus investing. The difference between... Okay, this is beautiful. This is beautiful work right here. So, and it's from the Plain Bagel. All right, yeah, we're watching this video right here. So the difference between trading and investing, because I'm doing both.
Is trading really just the same as gambling, except in the stock market? That's a question a lot of people have asked me, and this is the...
God is right here in front of me right now.
Gambling is when you're playing a game of chance. You can gamble at the casino, or you can gamble on Wall Street. But when I come into the market every single day to trade, I am not gambling. The difference is in the outcome. With more than a decade of trading experience that has been independently audited and verified to be profitable, I produce consistent returns. That is because rather than gambling in the market, I have a system and a strategy that I follow every single day. My name is Ross Cameron. I am a full-time trader. And if you want to learn more about the strategy that I trade, I have a free intro to day trading class that will walk you through my process of stock selection, where I get in.
This video is sponsored by Squarespace. Go to squarespace.com/theplainbagel to save 10% off your first purchase of a website or domain using code theplainbagel. If I were to ask you about stock trading, this would probably be the image that comes to mind. The New York Stock Exchange trading floor, a scene synonymous with stock investing itself. This is where traders meet in person to buy and sell stocks, finding deals for their clients and employers, and yelling tickers and prices across the trading floor. While this used to be how most trading was done, these days you can do most of the work online. And advancements in technology have even allowed everyday individuals to take up trading at home to try and make money. But despite the fact that trading involves stocks and other investments, it is often seen as a very different practice from investing, what you or I probably do when we buy or sell stocks. You see, being a trader, whether professionally or as a hobby, is different from being an investor. And while you've probably heard of people making quite a bit of money off trading, it's an area that most people are best served avoiding. Why? We'll answer that question and more on today's Plain Bagel. If you look at the literal definitions of the terms investing and trading, you probably won't grasp the difference between the two. After all, investing is the act of spending money with the hope of generating some larger benefit or return in the future, while trading is the act of buying or selling investments. It's not very clear how the two differ. And in fact, there is no technical distinction dictating what counts as trading and what counts as investing. But the terms are often used to refer to two very different approaches to making money from investments. An investor is someone who places their money in something and looks to profit from that asset growing over time. Whereas a trader is someone who makes money in the short term by buying and selling stocks frequently. In other words, while one relies on gradual appreciation, the other focuses on market volatility. Now, being a trader can mean a number of different things. Many companies actually hire traders to help them carry out their investment decisions. For example, an investment firm may decide they want to own shares of Plain Bagel Co., so they'll hire a trader to help them get the best price for the shares. In this video, however, we'll be focusing on traders who operate with the sole objective of making themselves money. And there are two main areas wherein this practice differs from investing: the timing of trades and the analysis of stocks. For timing, as we mentioned, investing is typically a long-term strategy, whereas trading is more short-term. When you invest in a stock, you're betting that over time the company will grow, either by expanding its asset base or its profits. You can invest in a company for as little time as you want, but generally speaking, you'll be aiming to sell the stock 2, 5, 10, even 30 years from now. On a day-to-day basis, the price of a stock may fluctuate, and indeed, some investors try to take advantage of that by buying when the stock's price is abnormally low. But once the purchase is made, the focus tends to shift to the long-term movement rather than the short-term volatility. Trading, on the other hand, is the fast and furious approach.
Yeah.
It involves buying and selling investments to take advantage of short-term price swings. Day trading, for example, involves individuals buying and selling stocks same day, while swing trading expands the process to a few weeks, months, or sometimes years. There are other styles of trading as well, but they all tend to fall under fairly short time frames, sometimes even making buys and sells within a matter of seconds. Because of this, traders submit many more trades than investors, and often cycle through many more positions. But selling something shortly after buying it doesn't alone make you a trader. So let's move on to the second point of distinction: the analysis. To understand how the analysis of a company and its stock price varies between traders and investors, we first need to explain the difference between a stock's price and its intrinsic value. Theoretically, the price of a stock only reflects the number of buyers and sellers trading that stock at that given point in time. And past this stock price, there's some intrinsic value, a true worth of that stock that only an omniscient being would know. Over time, the price of the stock should track closely to this intrinsic value as buys and sells factor in company information known by the investors. But human factors like fear or greed might lead a stock's price to deviate from its actual worth from time to time. Within the world of investing, people take two approaches to this information. Passive investors ignore short-term fluctuations in stock prices and look only to benefit from the rising intrinsic value, knowing that even if they do buy an overpriced stock, they should benefit in the long term as the aggregate market grows. Active investors instead try to estimate a stock's intrinsic value so that they can buy the stock for less than its worth, allowing them to benefit not only from the rising intrinsic value, but also from the return of the price to its intrinsic level. While these two approaches vary from one another, they both generally depend on the intrinsic value of a stock increasing. Traders, on the other hand, only care about the stock's price. There is no attempt to estimate the intrinsic value of their stocks. And indeed, many traders buy and sell stocks without even knowing what the company does, looking only to take advantage of the short-term swings or trends in its stock price. For this reason, it's common for traders to focus their analysis on technical indicators. These are measures and gauges that only take into account historical pricing information to help the trader determine whether there's a developing trend or pattern that they can quickly exploit. It's the graphs and charts you imagine when you think of a professional trader sitting in front of their 4 screens buying and selling stocks. Now, some traders do incorporate qualitative information into their research as well, but it is usually only to take advantage of a short-term shift that they're expecting in the stock's price. For example, if a trader finds out that a company is announcing news tomorrow, they may decide to buy the stock with the belief that the company's announcement will be positive, leading to a jump in the stock's price. In either case, traders generally only focus on snippets of a company's information rather than trying to develop a broader understanding of the firm's operations. So, those are the two primary ways trading differs from investing. It requires a very different mindset and operates in a very fast-paced, competitive environment.
All right, so
Some
now that
would
we
even
looked at
argue-
this video, let's ask Grok. So can I ask you, I just watched the video from the Plain Bagel. I just watched the trading and investing video, right? The difference between the two. Can I be both? Can I actually put passive income into dividend stocks? And while I, wake up one day and just say, oh yeah, let me put $10 in VOO, hop into a random stock that I feel like is doing very well, that I feel like is high volume, that has an uptrend for sure, and just trade, like active, like basically making money purely off investing, active and passively. and then making passive and active income, which is purely cash flow. Which investing is technically cash flow, but cash flow is more original, I'd like to think. Cash flow has a lot to do with like selling a product, I'd like to think. Just creating something and creating value, not investing.
Yes, you can do both. You can have dividend stocks for passive income and also buy and sell other stocks for active trading. That's actually what most people do. But here's the real talk. Most beginners lose money trying to pick individual stocks and day trade. The random stock that I feel like is doing well part is exactly how most people blow up their accounts. If you want to start simple, put most of your money into something like
Okay,
VOO
that's
for
exactly what
long-term
I'm doing. I'm putting most of my money in VOO. That's exactly what I'm doing. I'm not doing anything different. I'm literally putting most of my money in VOO. Keep a small amount separate to practice trading. Of course, I'm gonna literally make a live trading account soon after I practice on the simulator and I try this strategy out. I don't know. I'm gonna try this specific strategy out where I can see a trend going up and then down and then going back up again, or just generally a trend that goes up, goes down, and then just goes back up. That's what I'm looking for. I'm looking for a up and then a down and then back up trend. That's exactly what I'm looking for. I'm not looking for a up and then no, I'm specifically looking for a trend that goes up, down, and then on that down candlestick where it does some kind of mid, I don't know how to call it. I'm just getting into it, but where it does this even candlestick where it doesn't actually, it's not aggressive or, you get the point. I'm looking for an up, down, then a back up. And that back up is specifically where I'm looking to put my, whatever it is, whatever it's called in actual day trading. Entry, that's what it's called.
Yo, I feel you, but I gotta be real with you. You're describing what a lot of beginners chase. Buy the dip after a pullback in an uptrend. That sounds clean in theory, but in real trading, that exact pattern gets you chopped up more often than not.
So what the hell do I do then?
Do this in order. 1. Keep practicing on the simulator every day. 2. Stop trying to create your own strategy like that. That's the hard way. 3. Learn one.
Nigga, that is the proven simple strategy, bro. That's the proven simple strategy. You're gonna make me tweak. I'm gonna just take a shit on my phone.
Yo, chill, relax. If that's the strategy you want, then let's lock it in. Pullback strategy. Simple version. You only buy when the stock is already moving up strong, then pulls back a little and starts turning back up. That's your entry. You don't just randomly buy any dip. You wait for that third thing, then turn back up. You want to know exactly what
Yeah,
you're looking
nigga, that's
for
what
on
I'm
the
talking
charts.
about. I'm not looking for a random dip and then that goes back up. I'm specifically looking for that right there. I'm looking for the uptrend, then down, and then that candlestick that says I'm about to go back up, boy. Higher than before. That's what I'm looking for specifically. And if that's fucking rigged, then I don't know what the hell to say about trading because I feel like that is possible to find every day. I feel like that right there is possible to find every day.
That's actually a clean setup when it's done right. What you're looking for is called a pullback with reversal in an uptrend. Here's exactly what to look for on the chart. The stock is in a clear uptrend. It pulls back on smaller red candles, not a big crash. You wait for a green candle to form that breaks the high of the previous red candle. That's your signal it's turning back up. Then
Okay. So yeah, I don't let Grok finish because when I let that nigga finish, bruh, he likes to just cut off the like never talk to me again in 24 hours, and I don't like to do that. So I cut him off. I hang up on him before he gets to tell me, hey, the next time you get to ask me a question is in 24 hours. Because I hate that nigga for that. Again, I wanna just ask right now, man, that like God is with me. I don't want to make any mistakes or anything like that. And even if I do make a mistake, I want God to be with me and know that I'm making that mistake and learning from that mistake. I don't want to make a mistake and then just like never and dwell on that mistake forever and ever and ever. Let's make trading very simple, very easy, and very, very possible. Because trading is my active investing. And then investing is just generally, obviously, the passive version of it. But as I'm saying, like I'm having my money work for me. I'm not having You know, and I'm gonna take all the active income that I make, and I'm just gonna get my money to work for me. I'm literally gonna get my money to work for me. It has nothing to do with making money and having a good job or anything like that. I'm going to get my money to work for me. It's that simple. I'm gonna have to work for it a little bit, but I'm working so that the money can work for me. That's specifically what I'm working for. And it's what I've always been working for. I work a job, I get an asset, I use the asset to create something. For an example, I buy the computer, I use the computer to create videos. The videos are basically they're infinite assets. They're gonna be on YouTube forever. As a matter of fact, this live stream is gonna be on YouTube forever and ever and ever, and I'm gonna be able to use this live stream clip for the rest of my life if I want to. It's gonna be there forever. It won't get deleted unless obviously YouTube does not want nobody to see this. That's the whole point. That's the reason why I chose this path in life, because in life, you can't really control how much you genuinely make. You are not more valuable than the other person. Nobody's more valuable than each other. The only thing that makes the person more valuable is wisdom. Obviously, the only thing that makes a person more valuable is genuinely wisdom. Other than that, you'll be considered a fool, and that is not obviously wise. That's not valuable. That's not special to nobody, man. Being a fool is not cool. Being a fool is not cool. But yeah, that's the only thing that makes you valuable. Not like, obviously, you know, it's wise to repent. So that's the whole point. You know, it's wise to repent. And at the end of the day, if you don't repent, then you're a fool.
That it requires a fair amount of bluffing. This was more nations. So those are the two primary ways trading differs from investing. It requires a very different mindset and operates in a very fast-paced, competitive environment. Some would even argue that it requires a fair amount of bluffing. This was more so the case when traders used to talk in person about the stocks they wanted to buy and sell. But even today, traders often try to hide their true intentions when they submit an order. After all, if you can convince other traders that you don't want to buy something, you may be able to get it for a lower price, just like with anything else. All of this can make trading a very alluring practice for young investors. I mean, competition, fast trades, quick payoffs, it's got it all.
Yeah, trading is very competitive. But I believe that everything is competitive in a way, and uncompetitive. I believe everything is competitive, and everything is, there's no competition. Everything is competitive, yet there is no competition in the world, so there's nothing to worry about.
Explaining how they went from zero to hero with their $300 trading strategy, it probably seems like a fairly easy field to enter. But trading is a high-risk practice.
Yeah,
most
exactly.
traders put a lot of money behind their individual trades, sometimes even borrowing to leverage their returns, which exposes them quite heavily to short-term volatility of individual positions. It also requires a lot of effort and time. Many trades only end up yielding a fraction of a percentage point, meaning traders are continually rolling their money into new positions. And honestly, when it comes to amateur traders, the truth is there just isn't that much working in your favor. With such a narrow time frame, you're often forced to make decisions on fragmented information. And when you consider that you're competing with industry professionals with copious amounts of money, cutting-edge research, and even industry-best algorithms that can trade faster than you can say the word stock, it's just not a fair fight. Now, I'm not saying you can't make money trading. There are people who make a full-time living from their home with trading activities. And some companies even offer salaried positions for traders, like we mentioned earlier. So there are some merits in the field. But trading is a lot like playing poker. You can be very good at it, and indeed some people do make a living from it, but there's a lot of chance involved. And with other great players at your table, the odds are often not in your favor. So any advisor will probably tell you that investing is the better way to go for the average person. By carrying out more comprehensive research and holding over the long term, you're more likely to benefit from the broad growth of the economy and the stock market as a whole. Sure, you won't get that same rush as a tripled levered buy on an out-of-the-money put option, but that's probably for the best. After all, if you're looking for the rush of high stakes and not so great odds, you may as well go to the casino. At least there you'll get free drinks. Thanks for watching. If you like this video, make sure to hit the like button. If you like what we're doing here, make sure to subscribe. Hit the bell icon if you want notifications about future videos. If you have any feedback or topics you want me to cover in a future video, leave a comment down below. For The Plain Bagel, my name is Richard Coffin. Thanks for joining me today. So perhaps your trading venture isn't going to bring you the success and fortune you were hoping for, but maybe you have your own business you're trying to gain traction with, or maybe you're looking to get your name or your work out there for people to discover. While there's no surefire way to achieve success, there's no denying that having a website can help you with whatever you're working on. And today's sponsor has a great all-in-one tool to help you build your online presence. Squarespace is a website builder with one of the best structured editors in the space. You can pick from one of over 70.
All right, let's see. Investing with Rose.
That's the sound of an American oil company hard at work. Want to be a part of it? Listen up.
Hey everyone, welcome back to my channel. I am Rose. Now, I'm sure you've heard about how important it is to invest your money, put your money to work, but I also know how intimidating it can be when you're just getting started, which is why today I want to walk you through how to get started investing your very first $1,000. So in this video, we're going to talk about what investing is, and I'll also walk you through the steps of investing your first $1,000. We're actually going to jump on my laptop together, and I'll walk you through it and share my screen and show you step by step. Investing is basically putting your money into something, whether that's stocks, real estate, crypto, whatever, with the hope of getting more money back in the future. And the whole point of investing is essentially to keep your money safe from inflation. Because on average, the dollar loses about 2% of purchasing power every single year due to inflation. And I'm sure you've seen this in your own life. Your money doesn't take you as far as it used to. I'm sure you've noticed this at the grocery store, for example. Another place where I've noticed this is actually the other day, I was at a really nice steak restaurant with my boyfriend. It's called Monty's in LA. This restaurant has been around for decades and was passed on through the family. And we had a delicious prime rib steak. It cost $80. Now, when I was walking out after dinner through the lobby, I saw Monty's original menu from like 80 years ago. And the prime rib steak that I just ordered used to cost $3.85 back then. And this menu was like framed. It was sort of like
No way! Yo! And that... Bro, nigga, I'm speechless. Let's see what else they got. They got broiled Australian lobster motherfucking tails for $3.15? Eastern barbecued spar ribs for $3.15? Nigga, a boneless prime rib of beef for $3.85? Bruh.
in a museum. And so it was really cool to see the actual effect of what inflation does to your money, which is why you have to invest it so that your dollars keep up with inflation. And of course, if you do it right, it will also outpace inflation as well. That's why when people say like, wow, isn't investing risky? The real answer is not investing is risky-er, because then you are guaranteed to be a lot poorer decades from now. Not only this, but investing allows you to break out of that trading time for money sort of cycle that we're all in. It enables you to work smarter, not harder, because you've got dollars working for you. So for example, let's say you invested $500 every single month into what's called the S&P 500, which is the 500 largest stocks in the United States. If you had done this every single month over 30 years at a 10% average annual return, you would have just under $1 million at the end of those 30 years. And that's pretty incredible, because over those 30 years, putting $500 of your money in every month, you would have only put in $180,000 of your own money, and then investing did the rest for you to get you to $1 million. Put it another way, if you put $500 a month under your mattress every month for 30 years, you'd end up with $180,000, versus if you invested it, you have $1 million. That's basically about $800,000 of free money. So that's what investing can do for you. So if you're completely new to investing and feeling even a little bit intimidated, don't be. I want you to get excited about it, because who doesn't want to earn more while also working less? All right, so the first place to start is to check your 401k. So for those of you who don't know, a 401k is a retirement plan that you get through your work.
Come on, I don't have a 401k. Get out of my face.
Our regular account, these accounts will get this and benefits fees worth it. Now, and then whatever you buy in the Roth IRA is tax free. So it's the investment to go up.
I do like a Roth IRA though, because I just don't have after tax money right now.
The next step is really important. A lot of people actually forget this. They don't invest. So I'm going to reiterate, a Roth IRA or an account is just an account. It's not an investment. So just because you have a Roth IRA doesn't mean that you are investing. It just means that you have an investment account with money in it. At that point, it's basically like a fancy savings account, but until you actually buy stocks and bonds and investments with the money that is in the Roth IRA, you really aren't invested at all yet. So that brings us to step 4, which is to buy investments. This is the fun part. Basically, when you're deciding where to invest your money, it comes down to basically 2 options. You can either invest in stocks or you can invest in bonds. And I'm going to explain each one by one.
What
Stocks
the frick?
are basically little pieces of ownership in companies. When you own a stock, you actually own a tiny slice or a little percentage of a very, very large company, which is pretty cool, because it also means that when that company makes money, when it makes profits, if you are a shareholder in that company, you get a little slice of those profits and dividends as well. A really easy example is if you love Apple, you can buy Apple stock. That means you become a little tiny percentage owner in Apple. Now, there's different ways to buy stocks. One is that you can actually just buy the individual stock directly. So you can just go and buy Apple stock. Another way to invest in stocks is you can buy them as part of a fund. So think of a fund as just a bundle of lots and lots of different stocks. And the benefit of a fund is that it gives you instant ownership into hundreds, sometimes even thousands of different companies, all in one easy purchase. Think of it like this. If you're buying the individual stock, you're like buying one flower, versus if you're buying a fund, you're buying the whole bouquet with lots of different flowers in it. And the benefit of buying a fund is that it gives you what's called diversification. Diversification is just safety in numbers, essentially. By investing a little bit into lots of different companies, your financial future is not so dependent on whether one company does well. It depends more on a whole subset of companies, which is a lot safer than owning a little slice of one company. Because if this one company goes down, you're basically screwed, right? Because all your money is in it. Versus if you own a little slice of the economy goes through a lot of ups and downs. It does have some rough times, but it's essentially impossible for the entire economy to go down and for you to lose all your money. So investing in funds is a lot safer because it's diversified. It's also very convenient because you get all that diversification with just one easy purchase. So now that you know that if you want to invest in stocks, funds are the safer, best way to go. Now let's talk about how to actually choose choose a fund. There are a lot of different funds out there, but when you are choosing one to invest in, you want to look for one that has low fees. Because the thing is, every fund charges what's called a management fee. It's a tiny little percentage that they take off the top of your investment in exchange for giving you that convenience of owning all the stocks in one easy purchase. This is also called an expense ratio. They can be anywhere from like 0.0 something percent up to like 1 or even 2% and maybe even higher. So there's a lot of really bad funds out there that charge high expense ratios. We're talking like 1, 2, 3%, and they really don't give you any benefit in return compared to a lower expense ratio fund. So the first thing to look at when choosing a fund to invest in is what is the fee. I know that 1 or 2% doesn't sound like much, but the thing is, a small difference in the expense ratio, just compounded over many, many years, can actually make a difference of hundreds of thousands of dollars in what you actually end up with at the end. A good rule of thumb is to look for funds that have expense ratios of 0.5% maximum. There are plenty of great funds with expense ratios well below that. And now this brings us to my next point, which is the only type of funds that really fit this criteria of low expense ratios are what you call index funds. So an index fund is basically a fund whose holdings mirror the components of a particular index. So in case you didn't know, an index is basically a benchmark that has a lot of different stocks in it, and it just gives you a really quick picture of how a group of stocks is doing at any given time. So for example, one of the most well-known indexes in the world is the S&P 500, and this is an index of the 500 largest companies in the United States. It's just a really convenient, one number metric that you can look at to see how the economy is going up and down at any given time. So an S&P 500 index fund would invest in all the 500 stocks that are in the S&P 500 index. Pretty simple, right? Same with the NASDAQ, the Dow Jones, that's another index. There's many, many indexes that represent different segments of the economy around the world, but essentially an index fund will just hold whatever is in the benchmark index. Now, compare this to what you call an actively managed fund. An actively managed fund is where instead of the fund's holdings mirroring that of a particular index, it's just going to be some really smart person, a fund manager, who using his intellect and financial knowledge picks what companies go in that fund. And of course, in theory, this sounds great to have someone really smart picking the stocks that would presumably outperform. However, the data shows that these actively managed funds hardly ever outperform index funds. Your investment will perform better in an index fund that just blindly mirrors the components of a diversified index rather than leaving up to some smart person to try and outperform the index. So now you know why you want to go with index funds. One, they always have lower fees, and that adds up to hundreds of thousands of dollars of difference in your nest egg over time. And two, the alternative, which are actively managed funds, don't even perform better.
This week, we're
So far I've made every good decision when it comes to
free trading and
investing or my financial.
Fort Lauderdale. Inside
So
this
far I've made every
workshop,
good
you'll
financial
learn you
decision.
don't need to be a Wall Street
I'd
pro
rather
to
stay
trade
home and
like
everything.
one.
Like I've made every
Instead,
good financial
You'll
decision
make
that I
money with index
believe.
funds and also pay a lot less in fees. So that's how stock funds work. Now let's talk about bonds. Instead of owning a piece of a company, when you invest in a bond, you're actually lending some money to a company. So that's how you make money with bonds, by earning the interest that you get from having lent your money. They're a lot safer, but if the company makes a ton of money, you don't really get to benefit from that because you just get that interest. Compared to stocks, bonds are less riskier because in a bankruptcy situation, the bondholders always get their money back first, and if there's any money left, it's the stockholders that get paid last. So investing in stocks give you way more upside, but you also have more downside. Whereas with bonds, you have less upside, but you also have less downside. So all that to say, stocks and bonds are a really good complement in your investment portfolio because stocks, even though they're riskier, they also have a higher potential reward, whereas bonds, they are less riskier, but they also have lower potential reward, and combined together, they give you a really nice balance of the ideal ratio of risk versus reward. Now, as for how to invest in bonds, it's just like stocks. You can either invest in bonds individually, like you can invest in individual stocks, or you can invest in bond funds that hold many, many different bonds in one easy fund purchase. And for all the same reasons as stock funds, it's much better to invest in bond funds because you get that diversification. So given that you have a choice between stocks and bonds, now we get to the topic of asset allocation. What percentage of your money do you invest into stocks and what percentage into bonds? This really depends on your age and your tolerance for risk. So presumably, if you're a lot older, you're close to retirement age, and you really can't afford a lot of kind of ups and downs in your investment portfolio, then you're going to want to go with something more stable like bonds. On the other hand, if you're really young, you've got 20, 30, 40, maybe even 50 years until retirement, you have a lot of time to take a lot of risk and weather any ups and downs in the market, and you should be taking more risk than someone who's a lot older. So in your case, you want to invest most of your portfolio into stocks and maybe have a small percentage, like 5 to 10, 20% in bonds, just to sort of balance out the risk of stocks and smooth out your portfolio when the market.
What are bonds?
One good rule of thumb invented by Jack Bogle, who is the founder of Vanguard. He's also the pioneer of index funds. He's sort of like the grandfather of investing. He says you should own your age in bonds. So if you're 20 years old, you would own 20% in bonds and 80% in stocks, and that would be a nice asset allocation for your overall portfolio. Whereas if you're 60 years old, you could own 60% in bonds and have 40% in stocks. So owning your age in bonds is a good rule of thumb, but there's no wrong answer here. If you're young and you want to take more risk, it's okay to own no bonds at all and just put all your money in stocks. Personally, that's what I prefer because I want to go for the maximum amount of reward and gain, and I'm okay with the risk that that entails because overall, in the long term, I know my investment is going to go up, and I don't mind so much of the roller coaster ride that comes along with it. So now that I've given you a nice little overview, let's actually get into
Hey,
the
she's
laptop
on the
and
right
let's
track.
actually do this together.
I
I'm gonna
have
walk
nothing
through
but
my
stocks
brokerage.
here,
I use
bro. I don't got no
Fidelity,
bonds.
And there I've opened a Roth IRA. I've already transferred money into it, and I'm going to walk you through on my screen step by step how to buy $1,000 worth of your first few index funds. If you're wondering where to open your accounts, Fidelity is the brokerage that I use, but you really can't go wrong with either Fidelity or Vanguard. They're the two biggest brokerages that have been around forever, and they're both really great options. I've just been with Fidelity for a really long time, so that's what I prefer.
Okay, hold on.
And
Let me ask Grok something. Am I wrong for using Robinhood as my investing app? Because this lady told me to do Vanguard or Fidelity, which I was going to do one or the other, but it wasn't letting me lock in with Fidelity, or I don't even think Vanguard, which I think all I needed to do was wait, maybe. I'm not sure. But either way, I can't invest. Well, okay, I'm not going to say that. I'm using Robinhood, and I don't know if that's like the smartest thing in the world. I don't know if there's a difference. I don't know if there's, you know.
Robinhood's fine for what you're doing right now. You're just buying VOO, practicing with small money. Robinhood is simple and easy for them. The lady's not wrong.
I gotta go pick up this order. 18 items? Bro. If I go here and this thing is like, bro, let me see how many orders it is, because Okay. It's not that many things. I ain't gonna lie, I'm carrying a watermelon, but I'm out. Hopefully this isn't that stressful. I'm gonna stop streaming. For $12